Hey guys, Nima here. Welcome back to my channel. Now, as you know, I discuss many financial related topics on this channel, and in today's video, I'll be discussing beginner financial mistakes that are killing you. So I'm going to break down some of the most common pitfalls that could be sabotaging your financial journey, and I'll show you what steps you can take to dodge them. So go ahead and relax and get comfortable as I go ahead and dive into it right now. Now guys, I researched a lot of different articles that provided really nice breakdowns of financial and investment mistakes before making this video, and one that really stuck out to me was Tips for Avoiding the Top 20 Common Investment Mistakes by Robert Stammers, who's a chartered financial analyst speaking on investor education. If you are interested in checking it out, I've provided a link down in the description box below. So the first mistake to avoid on my list is skipping your homework. Now, just how I acted when I was growing up and thinking about money, I was all fired up to start investing right away. It was great that I was thinking this way and ready to get the ball rolling, but the truth is, it was one of the most common and detrimental mistakes that I could have made. I literally didn't know what I was doing, and I was thinking that by diving headfirst, I would figure it out along the way. Because of this, I quickly realized that I was just losing money without doing my homework first. In many situations, I do agree that you need real-life experience to begin learning what works and what doesn't, but in the finance game, when you are losing money, that journey ends really quickly. Now, when I'm speaking about doing your homework, I'm referring to a few key things. Firstly, understanding the basics of investing. This includes familiarizing yourself with terms like stocks, bonds, mutual funds, ETFs, and so on. It's like learning a new language, and you need to understand the alphabet before you can start forming sentences. Secondly is researching the specific investments you're considering. Start asking questions like, what's the company's financial health? What are the trends in their industry? Who are their competitors? Etc. You wouldn't buy a car without checking under the hood, would you? Well, the same principle applies here. And lastly, developing a clear investment strategy. Are you looking for quick gains or long-term growth? How much risk are you comfortable taking on? Your strategy should be a reflection of your financial goals and risk tolerance. Sure, mistakes will be made along the way, but at least with this strategy, you are calculated and you can at least attempt to avoid large losses. So guys, my simple advice to start off this video is that before you take that exciting leap into the world of financing and investing, take a step back, arm yourself with knowledge, and strategize. Remember, the most successful investors are not those who take the biggest risks, but those who make the most informed decisions. Alright, now moving on to mistake number 2 that you should avoid, and that is putting all your eggs in one basket. Now, I'm sure it's safe to say that you've heard of Miguel de Cervantes' quote, which is, don't put all your eggs in one basket. Well, it's a golden rule when it comes to investing. A common pitfall for beginners is the temptation to go all in on a single investment. Some beginners are convinced that it's a golden ticket to their wealth, and the truth is, it's very rarely a successful path. You are actually increasing your risk when you are not spreading out your investments across multiple different streams. Of course, there are rare off chances that you could win big, but there's an equally good chance that you could lose everything as well. This is especially true when it comes to investments like stocks, and there's 5 solid reasons why you shouldn't invest into just only one stock. Now I'll go ahead and list out these 5 reasons. The first is the lack of diversification, where you're vulnerable if that company struggles. The second is obvious higher risk, where market volatility can significantly impact a single stock. Third is the loss of control, where you can't influence how a company performs. Fourth is overexposure, where your investment depends solely on one sector's performance. And last but not least, the 5th reason, which is liquidity challenges. This is where selling large volumes might be tough without affecting the stock's price. Now guys, diversification is the key to mitigating this risk. By spreading your investments across different asset classes like different stocks, bonds, real estate opportunities, etc., you're not only reducing the risk of losing everything if one investment tanks, but also increasing the chances of catching high performers. A balanced mix of investments can provide you with a healthier, more sustainable portfolio that can withstand market fluctuations and deliver steady growth over time. Now let's go ahead and move on to mistake number 3, which is herd mentality strikes again. Alright, so the infamous herd mentality. It's a phenomenon we often see cropping up in the investment world all the time. So picture this, guys. There's a buzz going about a certain investment being a sure shot winner in the market. It's all over the news and your friends are talking about it, and you feel a strong urge to jump on the bandwagon and join in on the frenzy. So what do? You jump in, you invest a good amount of money, and then boom, you start to see the investment trickle down, but you stay in thinking it's going to rebound, but still it goes lower and lower, and before you know it, you've pretty much lost all of your money. That absolutely sucks, right? Well, that happened to me with Dogecoin. Not knowing what I was investing into and then jumping the gun just because I had friends that had done it, it severely hurt me and the money that I invested into it. But trust me guys, investing just because everybody else is doing it can often lead you down a rocky road. As a personal finance connoisseur, I've seen far too many investors get swept under the tide of popular opinion only to be left high and dry when the tide goes out. The issue with following the crowd is that it often leads to buying high when the hype has already been boosted and the price has gone up, and potentially selling low when the crowd moves on and the price drops. Another perfect example of this was the 2021 GameStop bubble. There was a significant surge in the video game retailer stock price, driven not by the company's financial performance, but rather by a group of individual investors coordinating on social media platforms like Reddit. In this particular instance, many investors jumped on the bandwagon as they saw that the stock's price was skyrocketing, largely due to the fear of missing out and the desire to be part of the winning team. Unfortunately, for a lot of people like myself, we exhibited the herd of mentality where we followed other investors' decision-making without necessarily considering the underlying value of the investment itself or our own individual investment strategies. Unfortunately, when the bubble burst, many latecomers who bought the stock at inflated prices suffered significant losses. This event showed the risks associated with following the herd instead of making informed individual investment decisions based on thorough research and analysis. Of course, the key takeaway here is that investing should never be a game of follow the leader. It's critical to make investment decisions based on careful research and your personal financial goals, not because of a trending hashtag or a hot tip from a friend. Just be aware of the herd mentality. It might seem tempting to follow the pack, but true financial success comes from thoughtful, informed decision making. Now guys, before I dive into mistake number 4 and what you should avoid, if you find this video helpful so far, I'd really appreciate it if you could smash that like button, leave a comment down below, and subscribe. Your support helps the channel grow, and I'm all about providing free and helpful content without charging for a course or anything like that. I have also opened up my YouTube memberships on my channel, so if you are interested in signing up for more financial assistance, feel free to do so. Okay, so let's get into it. Mistake number 4, and that's letting your emotions run the show. Now, for many people, investing is a freaking emotional roller coaster. You've got the thrill of a rising stock, the fear of a market crash, the greed that comes with quick gains, and so much more. These emotions can easily sneak in and influence your decisions in both good and bad ways. However, making emotional decisions in investing is generally considered very dangerous. I've seen how emotions can cloud judgment and lead investors astray. When you're riding high on the excitement of a successful investment, it's easy to become overconfident and start taking unnecessary risks. Conversely, when the market takes a downturn, fear can cause you to panic sell and miss out on potential rebound gains. A prime example of emotion-driven investing is the 2000 dot-com bubble. During the late 1990s, internet-related companies, or dot-coms, were the latest rage in the stock market. Investors were driven by excitement and greed, and they started pouring money into these companies and found out that many of which had never turned a profit didn't even have a clear business plan. The high demand for dot-com stocks led to soaring share prices, and the fear of missing out caused more and more investors to jump on the bandwagon. This further inflated the bubble, and of course, eventually, the market valuation of these companies reached unsustainable levels, and then when the bubble finally burst in 2000, it resulted in massive losses for many investors. This period of market history showed how letting emotions run the show can lead to disastrous financial decisions. Instead of carefully analyzing the fundamentals of these companies, many investors let their excitement about the new internet economy cloud their judgment, and that led to poor investment decisions. Again, guys, the key to successful investing is to stay calm and keep your emotions in check. This is where having a well thought out investment strategy comes into play. By setting clear investment goals and deciding in advance how much risk you're willing to take, you can help take the emotion out of investing. Remember, the stock market is no place for impulsive decisions driven by fear or greed. Sure, you could get lucky with another pandemic or overnight Bitcoin success, but if you really want to play it smart, you should instead aim for steady, long-term growth-based sound investment principles and a cool head. Watch out for those emotional pitfalls and keep your eyes on the prize. Now let's move on to the final 5th mistake, and that is not having a plan. So guys, just imagine that you were setting off on a road trip with no destination in mind. Sure, you might enjoy the scenery for a while, but soon you'd find yourself lost, possibly running out of fuel and having no real direction of where to go. Now, of course, if this is simply just a sporadic trip, there's joy in not knowing what's about to happen next, and you'll have some fun memories to share when you had some crazy moments, but the investing game without a plan is a terrible way to go about it. To some extent, you need a roadmap, clearly defined goals and strategies to know where you're going, or at least where you may end up. A case in point was the 2008 housing market crash. It was a complete mess because lenders were handing out mortgages mortgages to folks with unstable credit scores, and these mortgages had rates that shot up unpredictably. They bundled these risky mortgages into complex investments called mortgage-backed securities, or otherwise known as MBS, which spread the risk throughout the financial system. Now, with everyone scrambling to buy houses, the prices shot way up and in turn created a bubble that eventually popped, sending home values crashing down. Oversight and rules were way too relaxed, and lenders were allowing anyone and everyone to take huge risks. Eventually, when everything went downhill, it caused a huge global financial mess because of all the markets being connected. Many people had invested heavily into the housing market, believing it would continue to rise, but of course this wasn't the case, and those without a diversified investment plan found themselves facing severe losses. Essentially, these individuals had put all of their eggs into just one basket without considering the potential risks or having a contingency plan in place. Unfortunately, they were left financially vulnerable when the market took a downturn. On the other hand, investors who had a diversified portfolio and a clear investment strategy were better able to weather the storm. They had a plan in place that accounted for market volatility and included a variety of investments which helped them to spread their risk and potentially offset losses in any one area. So guys, the lesson here is very clear. In investing, as in life, it pays to have a plan. So before you jump into the investment pool, make sure you have a clear idea of your financial goals, your risk tolerance, and your investment timeline. Then you can develop a strategy that fits your needs and just stick to it, adjusting as necessary over time. And those are my 5 financial mistakes to avoid. I hope this video gives you some insight to avoid these potential errors in your investing careers. Remember, all investors stumble at some point, but what distinguishes you is learning from those slip-ups and advancing forward. I want to go ahead and thank all of you for watching this all the way through. Please share it with anyone who is currently or is on the path towards investing. If you have your own financial experiences or investing suggestions, please don't hesitate to share them in the comments down below. Don't forget to smash that like button, subscribe, and ring the notification bell for more videos every single week. Thanks again, and I'll catch you all in the next video.